Hello, YouTube and Patreons. This is something I've been wanting to do and didn't have time to do, so I thought I would knock it out. I put a lot of work to make this clean and crisp. A lot of times I ramble on. A lot of you love that too on the rants, but this one's pretty crisp. I put a lot of time into making some graphics to just simplify this concept. I'm always teaching, always talking about these things. Hopefully, this catches some of the new people in Patreon, people in YouTube that are wondering what the hell I'm talking about half the time. All right, so let's get started. So, what is a commodity super cycle and why should you be in it? Well, most investors start in the wrong place. Let's get clear about that. Most of you, many of you, I've been there. You begin by trying to pick the perfect stock. You analyze it, you look at the financials, maybe you look at charts, you look at technicals. You really want to win, right? Well, in reality, the biggest driver of investment success isn't stock selection. I talk about this all the time. It's sector selection. Capital or money, for those of you that just want to know it very simple, moolah, money, you want it, you don't have enough, you want more. Well, the stock market has a habit of taking people's money rather than giving money. It's a participant sport, but you ain't in the top club. You ain't an insider, or you wouldn't be watching or listening to this video, right? Du Bois Club is rigged, guys. There's algo, there's all kinds of things. So you've got to be really, really smart and you've got to get an edge and you really have to study history. You have to understand markets at a much greater level. And even when you understand them, and even when I teach you things about where is money moving and where can you make money, many of you fail to have the discipline, the technique, the patience, the lack of greed to be successful. Okay, if it was easy, everybody would do it. But I got to tell you, and many of my patrons have told me they've got in and they've had tremendous success, and then they start to tell people, "Hey, I'm following the commodity super cycle," and people look at them like they've got four eyes in their forehead. Like, what? You'd think that people would know it, but you know what? People are dumb. Wall Street takes dumb people's money. It does every day. It's taken my money for years when I was dumb, right? It's nothing offensive. How do you get smart? We're all born as a baby. A baby laying there at, a week old doesn't have a lot of intelligence, regardless of what some of you think about your child, right? Never call a kid ugly, right? But it's true. You learn, the brain grows, we develop. All right. So if you choose the wrong sector, you're swimming upstream against the market. Sorry, guys, I didn't put a comma or didn't put a space in there. I thought I checked this pretty well, but it's about 50 slides, but I'm going to go fast. Okay. So you're swimming up the stream against the market. You don't want to do that. It goes easier. Have you ever been caught in a riptide? I was. I almost drowned when I was 14 years old. I'd been out body surfing at Seal Beach in Southern California. Thought I was really good swimmer, Didn't know a damn thing about riptides. It started pulling me out and out, and I'm looking around. I got a friend quite a ways away, and the beach is just getting further and further. So I said, "All right." And I just swam with all the gusto I had. and I was a decent swimmer, but I didn't know to go sideways, wait out and I just went and went and went for 15 minutes, and luckily there was a lifeguard there that saw me. Right? And I took that last gulp of water like, "I can't do this anymore. I'm completely exhausted. I'm just going under." I just wanted to rest. And that was about the time that I got the orange, buoy that the lifeguards pushes at you. They know not to come right up on you because you'll grab them, you'll do anything you can to hold on, maybe pull them under. So they pushed that out there. And I got on the beach and I was embarrassed, right? So I could walk when I got up there, but I laid down. I needed 30 minutes just to recoup, mentally, physically, mainly. And it's embarrassing. And sometimes I relate things like it had nothing to do with being a good swimmer. Being cautious it had more to do with just not understanding riptides and what to do if you ever get in one. It wasn't pleasant for those of you who've been there. All right. So even great companies struggle in declining industries, right? So if you're in a sector that's being beat up, that's being kicked, thrown to the curb, but you like a particular stock, we've all probably been there sometime. And you ride it and you write it down more and then you ride it sideways for 2 years, telling yourself, it's gonna recover. It's dead money. Guys, sometimes you got to cut your losses, but that isn't, we're talking about the commodity super cycle. Meanwhile, average companies can soar if they're riding a powerful macro trend. That's what the first principle of building wealth is. It's simple. Start with the right macro sector. Well, I study history. I understand capital rotation and sector rotation and the velocity of money. And I watched that. Been watching it over the last 20 years. I retired in the 2000 to 2011 commodity supers. I played it for all it was worth. I'd already studied the 70 to 80. I made a few mistakes, but I knew I was in the right area and I stayed true to it and I focused and I moved in and I followed the commodity super cycle. And that's what you've got to do. So history shows that when commodity super cycles begin, capital tends to move through the same way, sort of in the same sequence. And I'll talk about that a little bit more. Since this is going out on public YouTube, I'm not giving any of the companies because once you know where to go, you still have to vet companies and know who to buy, right? So first comes gold. Once gold begins moving, silver, which has a monetary metal and a commodity side, right? It's a physical industrial metal, which we're really seeing it hyped up now because of shortages and technological and electric cars and electrification and solid state batteries and healthcare and 5G and satellite navigate. I could go on and on and on, but the industrial usage silver is going through the roof. So it makes this commodity super cycle even more interesting. But silver, first and foremost, throughout the history, hear the word history, of mankind, has been a metal that was valued. It always had a ratio to gold. It had a ratio in the ground. It's been kind of out of kilter because our little bankster buddies, JP Morgan, thought it was fun to make billions and spoof the market and pay maybe a, $50 million fine to make 500 million. Basically, it's a slap on the wrist. And so they've been holding and pushing silver down. Oh, there's another typo. Sorry about that. VER. Once gold begins moving, silver typically follows. More of the silver side of it being a proxy, a cheap gold, right? It's not cheap when gold has a 100 to 1 ratio. Silver is relatively cheap, but we got to 50 to 1. I expect by the end of this commodity super cycle, the end of this decade, we could see 10 to 1. So silver tends to act as a higher beta version of gold, attracting speculative capital. And oh boy, did we have that. Everybody said, the 45-year ceiling was $50. We'd been there in 1980. We went there in 2011. And even people in my Patreon and my community commodity super cycle, chat groups were saying, oh my gosh, we're 45. We're going there. It's going to crash. It always crashes. I said, no, that ceiling, that glass ceiling will be broken and it will become the floor, and that's where we went and where it will be. But it can be speculative, and we had FOMO. Look at January 27th, $120 silver. Oh yeah, we went past 50 silver, guys. That caught a lot of you guys' attention that don't really understand silver and don't really understand the commodity. Oh, that gold and those metals are popping up again. Let me chase it. Yeah, you buy it at 110, you buy more at 118, it goes up to 20 and you're going rah rah and it crashes down to 64. And you're going, "Oh man, I'll never do that again." So after silver, then the rotation. We're following the commodity super cycle, right? It's almost like you could document this, but you have to understand it before you can document it. So the rotation expands into base metals and industrial commodities. And then this era that we didn't really have in the 60s, we're talking about rare earths because we've become so technologically advanced in arms and in warfare and you name it, just technologically advanced, that we need more of these metals. Look at golf, the golf industry. You started having tungsten. You started having other things where, and I forget the name of it. What was when the two big golf companies there in Southern California were competing? The two main driver companies, right? Way back in to the early 90s, late 80s, early 90s when Tiger and was really ripping and everybody wanted a driver, right? Why would you go to those old small clubs, old technology? Everybody wanted a big-headed driver. Well, you got to have titanium, right? You don't have wood, you don't have other things, right? A wood was called a wood for a reason. Well, that's not what people hit anymore. So when you get into tungsten, titanium, you get, you have a jet or you have something else, you have a bomb, you want it to be hardened. So some of these rare earths make the difference. So there's always been things like copper, nickel, and rare earth. These sectors benefit from expanding industrial demand and global infrastructure investment, right? So Callaway was one of the companies I was thinking of, guys, with the two big competing companies. Now there's more players in there. Um, Eventually, the cycle spreads into energy markets: oil, natural gas, uranium, coal, and even renewables, wind and solar. So, what was I having my commodity super cycle people doing in January? Well, look at the video I put out right before this video. I gave everybody on January 4th and then again on the 14th my picks for oil companies and natural gas companies. And the average across almost all of those in 3 months had a 49% return, with the winner being 155% in 3 months. And another big oil company with a 14 plus percent annual dividend hitting 71%. So, guys, it's easy money when you follow that. You just have to know where to go. People thought I was crazy when I was recommending oil stock. Oil was 55 in most people's mind going to 40. And I said in December it's going to 140 and 240. Well, guess what? I've upped that. I think it's 340 to 400 now. So there's going to be a hell of a lot of money made in just the energy super cycle. But you have to know how to play it. There are better companies, right? But it's not difficult if you understand it, but it'll be extremely volatile. It'll shake most of you people right off that bull. And I'm going to talk more about that later in the cycle. We're already seeing the early remnants of this. Agriculture and fertilizers often benefit as higher energy costs ripple through the global food system. I made this. I'm really proud of this. This whole thing here. I said I got to show visuals on how we move through that super cycle. Typically, as gold moves, there's monetary fear, increased uncertainty in financial markets and investments. Well, we've got that in spades. How about the largest debt, $39 trillion debt? And they say with unfunded liabilities on pensions and other things, it's over 100 trillion. Well, guys, I got news for you. Go look up what a trillion is. Give me a trillion seconds, and I'll live longer than any man, woman in the world has ever lived. Think about that for a minute, right? If every $1 is 1 second, just Google it. Go look it up. You'll be amazed at what a trillion seconds is in time. And we got 100 trillion out there of total debt. And it's not getting any easier and it's not getting any better. So the central banks, who are the central bank? They're the treasury people. They're the people that manage the money. They know what's up. They know that Germany, the UK, Switzerland, Israel, US, Australia, Canada, China, Russia, Greece, Spain, on and on and on, France. We're all in debt. All the first world countries have a lot of debt, some more than others. How about Japan? I think the US is around 150. Japan's at 250. The yen carry trade was blowing up. So we've had the monetary fear. I'll show you later toward the end the gold and silver chart versus the Dow and the S&P. Sure, I could add the Nasdaq in there, but it happened to be an easier analog chart with the Dow and the S&P. And gold and silver, and what happens to beginning of these super cycles and how you identify them and what you look for. I mean, you can have dead money in the S&P for a decade. So if you believe the guy that you just put your money in for 40 years and you put it in the Mag 7 or an S&P index and you make a bunch of money, no, that's not how it works. That's what they want you to believe, but that's not how it works. There's massive underperformance, right? Yeah, you can have a 40-year record and get, 9% compounded on the S&P, but it's made up of years where you have 22% and then 3%. I think over the next 5 years, you're probably talking 1, 2 or 3% across the Nasdaq and the S&P for an average. Now, there'll be some winner stocks. There'll be some AI explosive companies. Look, we went through the 2000 dot-com bubble crash, big time. It took the Nasdaq 15 years to get back to the 5,000 level on the Nasdaq. Amazon sunk like a rock. But wouldn't you have want to own that rock 2 or 3 years after the dot-com bust? There were some winner companies that recovered and went on. There'll be some AI companies that will go up 30 or 40,000. But it's not going to be Nvidia, and it's not going to be the Mag 7. They're just too damn big. They're going to limp along at 2 or 3 or 4% a year at best. So monetary fear moves money to gold. Why? Because it's a store of wealth. Oh, but I thought digital gold was a store of wealth. Not yet. Hasn't proven itself. Maybe. When I see new highs, I'll start to assess. For now, I don't believe it. So gold represents safeguarding wealth during economic downturn. It's done it for 5,000 years. I could give you all of these metrics and say so many ounces of gold buys a house, so many ounces of gold buys a cow, so many ounces can make you a new a seat, a new suit on Seville Row, a really nice custom tailored. I'm not talking about a Hong Kong or somewhere where maybe the material's not that great. I'm talking about a quality man suit. So silver is at a dual purpose. So money flows, moves into gold because it's a store of wealth. It moves into silver because it's cheaper than gold, but it's a store of wealth that holds its value. Then it moves into base metals, industrial, and now we have more rare earths and other things that are participating. And then where does it go? It goes into energy, oil, gas, uranium, coal, solar, wind. So, technological and economic progress and the insatiable demand for electricity in the world's population. Those 8 billion people out there, they want what you have in America. They want what you have in Canada. They want what you have in England or Switzerland or other first world countries. They don't want what the poor countries have, Sri Lanka or somewhere like that. They want to consume a lot more. And they want gadgets and they want all of that. They want air conditioning. Some people don't even have light or electricity to read with. They want clean water. There's a lot of things that the emerging worlds want. And when your oil companies aren't drilling and they aren't investing enough because prices aren't high enough, then we don't have enough. Luckily, the U.S. has drill baby drill for a while now, but it wasn't that way for quite a while. It used to be a long time ago. But we're really under the gun for the critical metals and the rare earths. We don't have them and we got to get them. So they're trying to fast track a lot of that. And then what's the other piece? We're seeing a little bit of that because the Strait of Hormuz has a lot of fertilizer, has a lot of natural gas and oil, obviously. So it moves there. And so all things real, that's what commodities are: a cow, a beef, a pig, right? Corn, wheat, soybeans, coffee, milk, orange juice, all those things that we consume that are real, you can't print those. You can't fake those. You want an artificial orange? Or maybe one that they put in the plastic ones they put in the fruit bowl? I don't think so. So capital flows through sectors like a wave, right? Not Seal Beach, not a riptide, but a wave. It just moves. The money moves. So you want to ride the tide, guys. So the other thing that you really want to know, and I talk about this all the time. If you watch my videos, you know what the answer is. I'm not going to tell you now. If you can identify where we are in the cycle, you dramatically improve your odds of success. I knew exactly where we were when I told people 3 months ago to pile into oil. But a lot of people didn't believe it. They were too busy because we were killing it in gold and silver and copper and rare earths and base metals. Well, January was our comeuppance, right? January 27th, silver went from 120 to 68. We're at about 69 now. Now, I'm not going to do it here in this video. I pretty much know exactly where we're going. And later this year, it's higher than 120. but we got to suffer a little bit more. But we're not suffering in oil right now. The downside in oil is probably $70 if we call peace tomorrow, which isn't going to happen, guys. I got news for you. The upside, 180. Things don't go just right. So get right, set tight. I tell people what to buy. All you guys that are chasing these YouTubers out there, oh, you got to buy this fund. It's 37%. It hasn't had Navi road. You got to do this. You got to, it's a bunch of crap. It's like Jim Cramer was over there. It was a lot of crap. But once you identify the right sector, the next rule is just as important. And this is where discipline, guys, even guys in here in the commodity super cycle, they can find a way to screw it up. I talk and talk and talk till I'm blue in the face. And sometimes I don't tell you enough. But when I tell you 10 times and then you don't listen to that, who do you have to blame? You only have yourself. I've been there. Sometimes you're busy and you don't pay attention. You over leverage, right? You guys that go all in on margin when we're at $100 silver, and I say, yeah, silver is probably going to 300 by the end of the decade. You figure what can happen? We're going to 300. Well, you can go broke. You buy too much. You buy too much on margin, and it's 120, and it goes back to 68. You've lost everything. So don't get yourself in those things and stop over trading all the time. So let the trend do the work. It is volatile. Okay. I get it. It's hard to see something go up 300% and pull back, and now you're only up 50%. So it's okay to have some things in there. This is what I say repeatedly: trim profits on the way up. But don't panic sell out at the bottom. All right. Many investors feel the need to constantly trade. You jump in, you jump out of positions trying to capture every small trade. That's a sucker's bet. I probably would have been a day trader if I hadn't really in the day found this commodity super cycle. It's too much work. And even then, good traders have a 70% win ratio. You just have to win a lot more on your wins than you lose on your losers. And then that feels like a 90% because you have small losses and, more frequent and small losses and you let your winners run. That used to be something I was horrible at. Right? I do a few trades and I'd lose on them. So when I got one that did a quick 20%, I'm like, yeah, I'm out. I'm not losing on this one, only to see it run 200, 300% because I didn't know what I owned. I didn't know what sector I was in. I didn't understand all that stuff. Okay. But listen, most great fortunes in markets were not built through constant trading, contrary to people's beliefs. They were built by identifying a major theme early and simply holding on through the cycle. I talk about this all the time, not for now, but 7 years ago, identifying something like NVIDIA and saying, you know what, I think this is a good stock. And it keeps validating and validating. You know how many times from 7 years ago that NVIDIA had 50% pullbacks? Dozens of times. So if you happen to buy it and it goes up 20% and has one of those 50% pullbacks, you're probably like, I'm out of here. You cash your chips out, took a 30% loss because it's hard to ride through that stuff. I just did it in some of my gold and silver miners. My best one this year was up 1,200%. You know where it's at now? It's only up 720%. But I've trimmed out only what I invested. which was a 12 bagger isn't much. I don't like it being up, that remaining balance being, 92% of what I invested I still have, but I don't like it when it goes from a 12 bagger to a 7 bagger. But I'm okay. It's probably got, at least a 10 bagger left. I'll probably get out of all of it. It's a little more silver focused than gold. Probably 180, 200 silver. But I won't get into all the numbers, guys, that you need for this stuff, but they're not hard. I understand the formulas behind all of this stuff. So people built empires and wealth by identifying a major theme early and simply holding on through the cycle. But most people don't have the discipline or the emotional stability and the mental strength to handle that. It's true. So when a powerful sector bull market begins, the trend itself does most of the heavy lifting. Your job should be to simply stay on the right side of it. Of course, that doesn't mean never taking profits. It's important to trim profits, especially during mania moves. But I'll be honest, somebody in my Patreon just the other day asked me, hey, I didn't take enough profits on the metals and I saw them go way up and pull back. I'm hitting 52-week highs on all my oil stuff now. Should I be trimming profits? My answer was yes, trim some profits. But you know what? I would look at that also. And I don't want to over tell people what to do because you can't. You just give them good general advice. Yes, trim some profits. Now, if that's me, I would take probably only 10, 15% of what I had invested as profit. Why? Because I think we're still early in where oil's going. If we run to 180, then I say, hey, we may come back to 100. But with this war, and anybody who thinks that in 1 week this thing is over, good luck. And even if that looks like it's calmed down there, what about Taiwan? What about Russia? And that? What about the next place, right? So, guys, this is something that oil's been too cheap for too long. The big oil companies are underinvested. It's harder and harder to find rich oil fields, you know, billion barrel finds and so forth. It gets harder. The easy oil's all been found. You got to spend money. And with inflation rates, it costs lots of money. So there's a lot of good plays. I mean, when I have a database of 890 companies in gold and silver and copper, I couldn't even begin to tell you if I tried to set up a database of all the midstream, upstream, and downstream oil and gas related companies, tool companies, and just technology, all the things. There's probably 5,000. It's at least 20 times. Maybe it's 15,000 companies. So I don't even want to do that. But what I want to do is scrub through and find in little resources. I want to find the Transoceans and the Tidewaters and other little service and so forth plays out there. And I want to know which majors I want to own. So even the strongest, geez, I left the T out. Even the strongest sectors experience periods where prices rise too far and too fast. During those moments, it can make sense to trim a portion of your profits. I'm not perfect at this either. You ever had a day where you look, you make a bunch of selections and it starts moving, you turn on your computer and you look at your account or your phone and you say, oh my God, it opened. I am up, everybody's number is different. I'm up 57,000 just today in my account. Well, if that was on $100,000 account, that'd be a hell of a day. But you know what I mean? That's why money, it's all relative. So I don't use those terms. But when I'm up huge, I try to tell myself I should be selling because it probably isn't going to hold. We've gotten into such volatility and we can have a 10% push in some of these sectors and some of the winners in those sectors. I mean, I've had silver miners run 35% in a day. And I might, and I own about 35 of those. So I have some, from 7% up to 38%. And it's like you see that day after day for a while. It's like, damn, I better trim some. But it's hard to do, but you have to do that. Okay. At least recover your original capital. I don't always do that. I finally did that on the 12 bagger. But I didn't do that until it was about a 9 bagger because I didn't buy enough of the damn thing. I only had about $2,800 in it, but it was speculative. But you know what? I own 25 of those speculative ones with somewhere between 1,500 and 2,500 in each one. And I'll have a hell of a lot of 20 baggers when this commodity super cycle is done. I have some 5 or 6 baggers on majors that you almost can't lose on. So just stay invested. Don't get shaken out. Another important rule is concentration. Diversification has its place, but too much diversification often leads to mediocre returns. Look, I do a lot of these private consults. I'm going to talk about that toward the end for just a minute to tell you guys how to reach me, how I can help you in this commodity super cycle, etc. But the truth is, I've talked to some people and they have like 260 positions. They'll have 120 ETFs across every. It's like that's not the way to invest. You don't even know what you own. Listen, you're talking to somebody that has 49 gold and silver miners. It's way too many. But I don't have 240 total of anything. Probably have 100. And you know what the truth is? As hard as I'm working on Patreon and YouTube, I can't adequately manage that. But now with my Patreon, I have a really good income coming in from helping people. Feels good. But I probably would be making more money if I focus all that time on my own account because you need more time when you have that many positions. And I miss some things. I miss some things in my IRA, sitting on cash and don't, I see something, I tell other people to do it, and I don't go do it because I'm off making the next content. But I'm not complaining, guys. I have enough wealth. My biggest wealth for me is in physical gold and silver. Can't be in oil and it can't be in uranium. I mean, I can go out and buy spot uranium, right? You can buy USO, XLE, and all that, but you know what I meant. Why? Because I'm never depressed. I don't say, "Oh, gold went from 56 to, 44." I don't even think about it. Some of my gold I bought at 250 an ounce. Some of it at 800, some of it at 1,000, some of it at 1,500. I don't think I bought an ounce of gold over, 1,700. Just a lot of wealth accumulated over a lot of time. Because I know that there's no counterparty risk on physical. Nobody can ever take that away from you. I don't get a margin call. Yeah, it can be boring. The damn thing can sit there for 10 years. You go, why in the hell do I own this archaic relic? Well, just pull it out and look at it sometime. It's beautiful. And when it's 15,000, I'll still own it. It's just a lot more beautiful to me then. Guys, there's not enough of it. Let's see if Bitcoin can get there. I don't know. If you've done the macro work, right, this understanding the sectors and identified a strong sector, it often makes sense to concentrate in a handful of the best ones. Many of the greatest investors built wealth by owning just a few exceptional companies during powerful industry trends. IBM would have been one. General Electric, Procter and Gamble, Coca-Cola, Microsoft, Cisco, a lot of companies in their day, Nvidia, obviously. And I'm missing some guys. And there'll be some of these AI names that we barely know that'll go on to be rock stars. But if you're dancing in that game, there's going to be 8 out of 10 that go nowhere or crash. Just because they're in AI, they're not going to the moon. But there'll be some winners, some drones, some armament, there's some technology there, guys. No question. All right. Another major mistake investors make is overtrading. Overtrading is one of the fastest ways to destroy long-term returns. You get faked out and shaken out. I call it like the 7 seconds, 6 seconds when you got to ride a bull. That bull market wants to buck you off so bad. I use this analogy with the guy's slingshot. I got it from one of my psycho guys. It's so true. You'll see a lot of times in the stock market when the big money gets ready to unload, right? They're buying for a little bit and then they switch to selling, but they're FOMOing and they're promoting, and the general public is chasing. They're buying the dip, buying the dip, buying the dip until it worked. Institutional money pulls the plug. Who's left holding the bag? All you bag holders out there, dumb money. The inside money knew what was happening. The CEOs, the CFOs. So if you're always trading like that, it's hard not to get caught. It usually happens for emotional reasons. That's what I said. I've got an options tier. I like to go out a couple times a month and update it. And the people would probably like it if I had stuff in there every day. I could put hundreds of trades in there, to be honest. But if I don't feel it, and I don't feel there's an 80% edge and probability, I don't put it in there. I am trying to get to swing trades. It's easy. I mean, I could be doing right now in these oil stock a ton of swing trades because oil is still moving, still volatile. It's up in the air. Our metals will. They just got a few more weeks. And the whole market, the other thing right now, to answer that, even in the oil, I expect April to test lows significantly lower than where we are on the indexes and also on gold and silver. And oil may get reeled back in. I'm not sure. I doubt that. But great trends require patience. You really have to have patience in the stock market. Like I said, that gold, I mean, gold's a perfect example of that. It's easy when you got physical and you got it in a vault or you got it. It's not even where you can go touch it all the time, but you better know that you're in control of it. Otherwise, that's crazy. But the idea being that it's 360 days of boredom and just massive euphoria for 5 other days, right? Watching silver go from November to January was a sight to behold, something I've waited for a long time. But now that we're in the cycle, where do I think silver goes? 350 to 400. Used to be 250. In many commodity bull markets, the majority of gains occur during a few explosive periods. Miss those months, and you miss most of the cycle. Patience is not easy, but it's one of the most valuable skills an investor can develop. Another reality investors must accept is volatility. Well, there's volatility and then there's volatility. And I've been telling my Patreons we're going to have a hell of a lot of volatility over the next 3 or 4 weeks. even more than normal. We've had a lot. Commodity sectors are naturally volatile, more volatile than the average stock. It's not unusual to see corrections of 30% or even 50% within a large bull market. Matter of fact, everyone has had that. There's never been a commodity super cycle, the 70s, I talk about the 2000s, that they didn't have close to a 50% pullback at some point. That's brutal, guys. It's hard to stomach. When you see it starting, you have to react quickly. I don't tend to sell my positions. I tend to load up on hedges if I'm not already loaded up. If I own gold and silver miners and ETFs, then I'll go buy a bear 2x gold and silver bearish ETF. And as I get profits in that, I take them off because I know that, yeah, there's more downside, but then there's going to be upside. So I just want to get in it, write it down, get out. And of course, my account is going down more than it's going up. But I'm not trying to be perfect. If I sold every single thing I own and tried to time exactly but nobody can do that. Nobody. I don't have the time, but nobody can do it, even with the time. So if you're not prepared for that kind of volatility, you often sell near the bottom of corrections because you panic out. You tell yourself, I can't sleep. I got to get rid of this. I can't take any more loss. I've had people tell me that. I've done consults where they're crying. They're like, "Oh my God, Misty's killing me. This one's, I bought this. I thought this. It did it for a few months. It's not doing it now." I am so empathetic. I'm not making fun of anyone. I'm very empathetic. I hate it. I just did a video on credit, private credit and private equity. I'm so angry at the lack of regulations on those people that are doing that and how dangerous that is. That may be our little kick us in the butt in the next few weeks. Let's see. It's hanging out there. I don't like it. And it's not the rich that get hurt, guys. It never is. It's the Joes and Janes of the world. So volatility is the price you pay for large returns. It's impossible without that. At 1,200 bagger, I think when I first bought it, it was down 30% in a month, right? And then maybe the first year I was up 20% after that. But then slowly, it started getting 100% years, 150% year. Then I had one year where I was up 480%. Now all of a sudden I got a six bagger, right? You got to be patient, but you got to know what you own. True risk isn't volatility. True risk is permanent loss of capital. So don't over leverage, guys. 10, 20% on margin if you need it. Be very cautious. Make sure it's not at the top of the market when all the FOMO is in. Another key factor in commodity investing is understanding supply. Unlike some industries, many industries, commodity bull markets are often driven by supply shortages rather than demand booms. Just the nature of the beast. When companies stop investing in new mines, oil fields, or energy infrastructure, supply eventually tightens. And when supply is tight, even small increases in demand can drive prices dramatically higher. That's why some of the biggest bull markets in history occurred after long periods of underinvestment. They go hand in foot, which brings us to another valuable habit. I do this massively. Study history. Yes, history. History teaches us so much. Commodity markets tend to move in cycles that repeat over time. Looking at past periods like the commodity boom periods of the 1970s or the early 2000s provides useful perspective. While history doesn't repeat perfectly, but it often rhymes. Looking at past periods, right, provides useful perspective. Okay, when investors understand past cycles, they're far less likely to panic during normal correction. But be humble. Okay, have humility. Don't get overconfident. I can buy silver at any price. I can chase this. Silver's going to 300, and it likely will. But you get overconfident at 150 thinking it's going straight there now when it has to revisit 90 or 100 again. And that's when you get caught. And if you margin that all up or do call options, you're just throwing your money away. Do it intelligent, right? I'm conservative. There's times that I've missed opportunity because I wanted a little bit better price. I wanted a little safer price on that option. But you live to write again. You live to play again. I got rich the first time, was able to retire early. Rich for me. Finally, and perhaps the most important principle of all, I mentioned it, is humility. Markets are bigger than any investor. No one gets every call right. If you find somebody that says they're perfect and they do it, run. Don't walk, run. So the goal here is not to be perfect. Every one of these principles and every one of these things I talk about till I'm red in the face. I go on and on and on in my rants. Discipline, get right, set tight, trim. I haven't said it enough. Trim. The goal is to participate in the big trends, avoid catastrophic mistakes, and stay invested long enough for compounding to work. I hope you understand that, right? Rule of 72. It's the simplest rule in the world for compounding. Look it up, Google it. In the end, wealth in markets usually isn't, I left the T out there, created through brilliance. Although we'd like to think that guy's so smart, he beats the market. It's created through patience, discipline, and positioning yourself in the right sectors at the right time. If you can do that, the market will often do most of the work for you. As I've said, in a bull market in the right sector, they do the heavy lifting for you. You can pick an average stock and still have a winner. So let me sum these up for you. Hopefully you like these new visuals, guys. I know some of you are tired of looking at my spreadsheet. I'm tired of looking at the spreadsheet. I cleaned up my logo. I tried to put some color themes in here. I worked really hard on this stuff, guys. And I'm still going to do some of my spreadsheets sometimes when they make sense, but I wanted to do something, and I really felt like anybody that comes in new into my Patreon, they need to understand these. I say them all the time in my videos, but like anything, if I say it over here, they see this, and I didn't say it again that time. So now there's something. If you want to understand the commodity super cycle, anybody, you're on YouTube, you watch this, tell a friend. You don't have to join my Patreon. It's my contribution out there. You won't find anybody else, I think, that does it at this level. So start with the right sector. Follow capital rotation. Let the trend do the work. Trim profits during mania moves. You don't have to trim every time, right? But you do need to trim. Concentrate in the bet and not stops. If you're fearful, then you don't believe in that cycle. If gold's 2200 and you see it run to 2400 and you buy a gold stock and you get a 10% profit, and I'm telling you that gold's going to 15,000, that doesn't make a lot of sense. But if gold runs to 4,000, 46, 48, 52, and it's just gone vertical, then look out below. We're going to get a correction. right? There's a time and a place. Look at the impulse, look at the intensity, look at how far it's stretched above its 200-day moving average. There's just some logistical things that take place. I study these commodity super cycles. I put charts out, I analyze the chart, I tell you what I expect. I don't know perfectly. But like I said, I think on these metals, we've got lower lows still ahead of us. Near term. Okay, let the trend do the work. Trim profits. Concentrate on the best ideas. Don't own hundreds. Whoops, that went too fast. I don't know. Oh, let's go back. All right. Avoid over trading. Expect volatility. Don't be hanging a stop 3% below what you just bought a gold and silver stock for. They're volatile. I tell people if you're getting in, even in the impulse wave, and it goes down 10%, don't put a stop. The market maker will just run it down to get your shares. You know, I talk about that slingshot effect. That's when it's been beaten down and the smart money is ready to gobble it up. And then they send it down one more time, a little bit lower, just to catch all the stops. Now everybody's out and the market reverses like a slingshot. You pull it back tight, and you let go. What does it do? It rockets out, right? But you had to pull it back. And that's what markets do a lot. They have a slingshot effect. But that's only good in an up market. You can have a slingshot effect that never goes out, right? It crashes down for a week. Look out below, it goes down 30%. And it's going to keep going. Not in the right sector. It's not, benefiting from these other things. It's not just the volatility that it got overheated in its correction. There's a difference. Yeah, if gold went to 1,000, I'd say, yeah, we got a problem. But hell, gold could go another $1,000 down from where we're at. And to me, that's not, it's still a bull market. I don't expect that. I wouldn't be surprised if we had an intraday move like that. I think 3,900's coming in gold. And if we get hit enough on this credit, private equity, and the market takes a 25% hit, could I see gold intraday maybe getting shoved down toward 3,000 or some crazy number? I'd be buying like crazy, miners and other things. But it wouldn't stay there, even if it traded there in a day. I don't expect it, but it could happen. So you have to be ready. You can't sit there and be all optioned up and all long on this stuff always. So I thought this was worthwhile making, and I showed it to you before, but it is in the end of the presentation. And so I talked about it. Monetary fear, money moves to gold, gold runs, and gold did. Gold ran for a year and a half before silver really woke up, and the miners woke up just before silver. That's when I started my Patreon, when the miners woke up. Now I had some stock recommendations, and those things, I can't even tell you how high they went from August. That August to the end of January run was something to behold. And most people are still up. Yeah, if you bought in December or January, some of your positions are down now. But just hold through the end of this year and see where you are, and another year after that. So when you get to 7,000 gold and 8,000 gold and 10,000 gold and 12,000 gold, these miners will be printing money like they are now. They make money at 3,500 gold, at 4,000 gold, 4,500 gold. So get right, set tight. So, drivers around the cycle: monetary inflation, supply shortages, industrial demand, energy costs, food inflation. Almost done, guys. This one I put in here. Look, go out and Google and AI this. They have a few different McClellan oscillators. But bottom line, the McClellan oscillator talks about how oil follows gold by 18 to 20 months. And this typically takes place in a commodity supercycle because gold's run, silver's running, base metals, and it's time for oil. 18, 20 months later, it's time for oil. That's exactly what happened. So here we are. We're going to have an oil price 2024 runs up. Man, in 2025 it ran. We had a little correction. So what are you doing in 2026? Maps there. So here's oil starting to move. 60, 70, 80, 90, 120, 100. Where are we going? A hell of a lot higher over time. So I think you get the concept, right? Okay. Commodity super cycle. And then I'm going to show you some real life charts that aren't mine. Okay. I made all of this stuff. It's time consuming, but I think it's worthwhile. So here's our 70 to 80s boom. Gold, silver, oil. Most of you guys aren't old enough to remember. I was. I owned a car, drove to work in the 70s. So, finished college. So I know all about that being in the line, even in odd license plates. I don't know if that was in all states, but it sure was in California. Gold, silver, oil explosion, inflation crisis, right? 2000s, we had China. China was the world's factory. In a lot of ways, it still is. But it's even trying to grow out of that. China's industrial boom, oil, copper, gold, silver surge, right? You notice oil, you notice precious metals. Here's our current cycle. I got it going to around 2030. Could go to 32, could finish in 30. We'll see. Increased global conflicts, massive debt to GDP levels. I didn't list that. Energy shortages, AI boom. We need to double our grid. Our grid is 30 to 50 years old. It can't handle it. We're in trouble. We got a lot of things. We can't build all these AI data centers and all this creative stuff that we're trying to do. So there's been an underinvestment in commodities. So the first two I'm going to show you here, and the last one for this cycle, I'm going to go show you the live chart, and then I can manipulate it because it's pretty fascinating. So the S&P 500 and Dow versus gold and silver. So with this system that I went out to the website, you can drag it and you can focus in, like this one's on a 10-year period, right? And 20-year periods. And if you move it, then when you go past the gold and silver, then the Dow and the S&P move up. It's pretty fascinating. But this is a prime example, right? So this one I can't move, right? Sorry. Um, so they didn't do much in the beginning, right? The 70, 71, Nixon took us off the gold standard. But watch what starts to happen. Yellow is gold, silver is silver. Look at the Dow and the Nasdaq. They're basically nothing. Maybe 1% a year, 2% a year. You see a little movement here. Starts running, it almost looks flat. That's what they do. They go, and I remember this. I was playing it like, well, no, sorry. 2000 was the one I was playing. I wasn't playing it here. I knew about it. I watched it, but I didn't understand commodities. Never bought any gold. Didn't, I tell the story that my boss in 79, I remember her selling the heirloom silver tea sets and all that her grandmother had, and how much, oh my God, silver's $45. I'm going to go cash in. And I was like, oh, okay. So that's what happens. And then you have blow off tops. So almost like a wave, a wave one, a two, a three, elongated period, and then a blow off top. You can tell that's a blow off top. So look at this. It didn't do much. But what tends to happen is this is a kind of a flat, well, basically the S&P, if you look at 65 to 80, it didn't do anything. That was lost 15 years. Look at 2005, or sorry, look at 2010 to 2025. Oh my God, you wanted to be in the NASDAQ. You wanted to be in the S&P 500. That thing had a phenomenal 15-year run. Gold didn't do shit except for the last couple of years. But now it's moving, and I'll get into that. All right. So you want to be where capital is flowing. So here's the next one. This one I bought, I participated. I know this cold, right? So you're going back to 2000, and look at this flat, flat, flat on the Dow. And the red is the S&P and the blue is the Dow. Doesn't matter. They're not going anywhere, right? 250, 500, 750%. So look at silver. And right in here, guys, this was the 2008. Gold and silver are moving, stock market's not. Then we get the mortgage crisis, right? In the latter part. So everything sold off. The market sold off, gold and silver sold off. The miners sold off worse than the metals. So there's some overlap that we could be around this time frame. But we're also, I think, a better rhyme with the 70s bull market, to be honest. But what may happen in the markets this year could be like 2008. Again, it's not a 1929, but it's ugly and it draws it down a lot initially. But I don't see a crash market. I don't, other than a 20 or 25% pullback in the Dow. And with all that leverage, that could take stocks down 30 and 40%. But look at this. So then gold and silver ran together, and then no more. Silver said, "Oh no!" Right? The silver squeeze, only to fall down a lot. All right. So let me bring you final, because there's no more. Oh, so this is a final thing, and I'll do one more slide for you guys live on the current one. So, commodity super cycle. The real secret to building wealth in markets, I alluded to it. Be in the right sector at the right time. Be patient. Be disciplined. The trend does most of the work. Don't overtrade it. Don't overthink it. But rotate, right? You got a lot of capital in gold and silver. They're pulling back, right? I had people getting in oil. Some people didn't have money. They had so much in gold and silver, but they should have been taking profits and putting it in the oil companies in the December, and then again on January 4th and on the 14th, and then silver gold popped. And then they went down pretty aggressive and went back three-quarters of the way back up to the top in February, only to come down again in March. And I think we got one more low in April, and then I think it's off to the races again. So the trend does most of the work. All right, guys. So I'm going to show you this. And so this slider and this stuff, it lets you do kind of some cool stuff. But at the same time, it's confusing. It moves quick. But just to be fair, look at an era. Remember I talked about, I said from, like 1990 to really 2015. I don't know that I can get all of that on here. Well, this is this is the 2011. So here's gold and silver starting to wake up. 2001, they're starting to run, right? 2005, this doesn't look like a lot, but it is. And look what the stock market's doing. Stock market's going down. Then the market turns, the stock market, and starts moving. But look what gold and silver are doing. They're out moving it. They both correct in the 2008, 2009, but look at the outperformance here in the gold and silver, especially silver. But now the outperformance, if you look at this, 2015 was gold low, right? So here's what happened. Now look at the end of this. Now what's happening? 21, 22, especially from here on. Look at that. These markets have moved up some, but they're rolling over. Sure, we're pulling back right now on gold and silver. I don't have oil on here. You know where that would be. But this commodity super cycle has a lot higher to run. I think this is similar to that. 2008, 2009, we're going to come here a little bit lower. We're going to pop up, trend sideways a little bit. I think we go to new highs in silver and new highs in gold this year. The banks have us at 6,600 on gold. We're at 44 right now. I think we can go to 39, 38. Let's see what the low is next month. So, guys, there's a lot. Hopefully, this thing explained it. A lot of people say why. You can get into the why. I talk about another thing, and I'll wrap this. Somebody go, "Oh, I don't believe oil is going. What's going to cause oil to go there?" I said, when you're in a commodity super cycle, things do things that they're supposed to do. There's always a reason. Why did World War One start? Why did World War Two start? Somebody always picks something out of the history book. What triggered the Civil War, right? So, but the truth is, there's disconnect. You look at the Civil War, there were people that didn't own slaves and people that owned slaves, and there were economic and difference in beliefs, right? Is look at the US today. I could see us in a civil war again. Why? Just look at polarized news reporting, look at polarized politics, look at people that say, don't tell me about Trump. He's Hitler, he's this. They won't look or hear. And then you got people that are so pro Trump, they don't want to even hear anything negative when there may, in fact, be some negative. So when you're that polarized, that's what happens. So in these commodity super cycles, there gets to be such physical debt, fiscal debt, irresponsibility, layers and layers of politicians, career politicians that don't know how to do anything but spend money. And you wonder why we're in the debt cycle. And you can only do that for so long. We've been entrusted with the world's reserve currency. And that's likely coming to an end. So we've got all this conflict. It's so easy to see that this commodity super cycle may be the one that runs the furthest and the highest, and it's crazy. But the volatility will kill you. If you sit there and say, oh, yeah, we're going to 15,000 gold, we might go to 30,000 gold. I don't know that I want to live in a world that we're at 30,000 gold. I don't know if I'll like the world at 15, but I'll be a lot richer. But where am I going to put the money? That becomes a decision. Do I really want it back in dollars? I doubt it, because I expect them to go a lot lower in value along with every other currency. At least the dollar has held its value compared to other currencies for quite a while, mainly due to that reserve currency status. But that's being challenged. I don't have to tell you guys, you've heard it all, but I thought this video, give me comments, give me feedback. It was intended to educate, not recommend something, just to educate. Because that's what at the end of the day, I enjoy. I want to help people. I want to educate. All right, guys, that's it. Bye for now. Not financial advice. I'm not a financial advisor. Bye for now.